Hello, welcome to Advanced Financial Accounting class. We'll be talking about group accounting and business combination today. Group accounting and business combination. And for this, we will look at the concept of control and group structure. We will look at the preparation of consolidated financial statements. We will also look at business combination and acquisition accounting. The module will also look into goodwill and non-controlling interest, intra-group transactions and balances, and lastly, uniform accounting policy within a group. Just like I do say, we will just look at this briefly, and we have a robust notes to explain each of these concepts further. Group accounting involves preparing consolidated financial statements for parent company and their subsidiaries, and it is very essential for presenting a complete view of group's financial position and performance. The key standards include the IFRS 10, IFRS 3, the IAS 27 and the IAS 28. Let's look at the concept of control under IFRS 10. Control exists when an investor has 1. The power over the investee, 2. Exposure to variable returns from involvement with the investee, and 3. The ability to use power to affect those returns. And control can exist without majority ownership, as demonstrated in example 8.1, which you see in the notes. In preparing consolidated financial statements, consolidated statement combines assets, liability, income, and expenses of the parents and subsidiaries. And key steps include combining like items, eliminating the parent investment against subsidiary equity, fully eliminating intra-group transactions and balances, and non-controlling interests are shown separately in equity and profit or loss. For the business combination, the IFRS 3 requires the acquisition method for all business combinations, and steps include identifying the acquirer, determining the acquisition date, recognizing and measuring identifiable assets, liability and non-controlling interest, and lastly, recognizing goodwill or a bargain purchase gain. For goodwill is calculated as the consideration plus the NCI plus previously held interest minus fair value of net assets, and the NCI can be measured using the fair value method, which is full goodwill, or the proportionate share method, which is the partial goodwill. And goodwill is not amortized but tested for impairment annually. Looking at eliminating intra-group transaction, all intra-group transaction or balance and transactions must be eliminated in consolidation. An example of this include the intra-group receivable and payable, intra-group sales and purchases, and unrealized profit in inventory and non-current assets. And elimination ensures that the group is presented as a single economic entity. Uniform accounting policy and reporting dates. Consolidated statements must use uniform accounting policy across the group, and adjustments are made if subsidiaries use different policies in terms of maybe depreciation method. And parent and subsidiary reporting dates should align. and the difference cannot exceed 3 months. In conclusion, group accounting is complex but critical for transparent financial reporting, and it requires careful judgment in assessing control, measuring fair value, and eliminating intra-group items. Having a mastery of these principles ensure consolidated statements faithfully represent the group financial position. Thank you for listening.